Hi everyone, before we get started, I just wanted to show you the T accounts from Chapter 2. In Chapter 3, we're going to just be dealing with a few T accounts, and I wanted you to just see what we had done in Chapter 2 so you could remember that as we are going through Chapter 3. Okay, I just want to go through some of our adjusting entries for January. And the reason we have these adjusting entries is because things occur during the month, and for simply reasons for efficiency, we're not going to check them on a daily basis and see that they've been used. So for example, supplies. It's more efficient to wait and check them at the end of the period. So when we did our supply inventory at the end of January, it shows that we have $700 of supplies on hand. So that means we've used $300 worth of our supplies. So that means we're going to have to go ahead and debit supplies expense, right, for $300. So our first transaction is supplies expense. And then what we're going to have to do is credit supplies, right, because we've used our supplies. And the T accounts I'm showing are the only accounts we're going to be using for right now that we're adjusting. The other accounts will come into play later, of course. And if you have the T accounts from the last chapter, you can just put them all together and then take those totals, those balances, and just put them right onto the trial balance. And of course, I'll be sending you a trial balance. Okay, our next item is insurance expense. We've used 1 month of insurance. Remember in January we purchased a year's policy. So now we used a month of that policy. So we need to go ahead and record that. So again, we're going to have an insurance expense account. We're going to debit that for the $100 we used. And the way you would have figured out that we used the $100 is you would have just taken the $1,200 divided by 12 months, and that would have equaled the $100. So as I was saying, we're going to go ahead and we're going to debit insurance expense. And now we need to credit our prepaid insurance, don't we? So we're going to go ahead and credit prepaid insurance for $100. The reason we're doing that, of course, is because, remember I mentioned in Chapter 2, prepaid expenses, what they are the expense hasn't actually incurred yet, so it's considered an asset until we actually incur the expense. At this point, we've now incurred $100 of that prepaid insurance expense. So this is the point that we're going to actually expense it out. The next is depreciation. And let me explain to you how depreciation works. In our example, we have the office equipment, and its useful life is 20 months. Now what that means, we purchased that equipment for $5,000. It has no residual value. What residual value is if what you might get for it at the end of its useful life. In our case, we have nothing. There's no residual value, no salvage value, so it's worth 0 at the end of 20 months. But what we would do is we're going to take the $5,000 for our equipment, and we're going to divide it by the 20 months. That's its useful life, and that comes out to be $250 a month. So each month we are going to expense out $250. The reason we do this is because we're slowly using that equipment. And of course what we have to do is we have to expense it out, right? As we're actually incurring expenses, we want to expense them out. So we want to expense this out in our income statement. So we want to go ahead and we'll debit $250 for our depreciation expense. And then the account we're going to credit is an account we haven't talked about yet, and that's accumulated depreciation. And what accumulated depreciation is it's a contra account for the asset account that it is, of course, attached to. So it decreases that asset account. So right now my accumulated depreciation account has a credit of $250. Remember, our equipment account had a debit balance of $5,000. So if you wanted to know the book value right now of that equipment, it would be $5,000 minus the $250. And I apologize, I know I have really messy handwriting, so I do apologize. So right now, the book value of our office equipment would be $4,750. Okay, I'm going to pause for just a moment so that I can continue on. Okay, all of those items that we just went over were adjusting entries for deferrals, the utilization of the supplies, and expensing out a month of our insurance, and accumulating our depreciation, then expensing the depreciation out. Had we not done that, our assets would have been overstated, and our net income would have ultimately been overstated, but what would have occurred is we would have understated our expenses, right? So by understating our expenses, we end up overstating net income. The next item that we're going to do is the interest we owe. And I got it written up there. We had $1,000. Remember, we took out a note payable for $1,000. And there was 5% interest on that. And we have utilized 1 month of that interest, right? So we're going to take 1,000, multiply that by 5%, and then multiply that by 1/12, because it's 1 month interest. And I have it as $4. I know it does actually come out slightly higher. It's like $4.17, I believe. But we're gonna, for our purposes, we're just gonna use $4. So what we would do is we would go ahead and debit interest expense for the $4, and then we will go ahead and we will credit interest payable for the $4. Again, now this is an accrual, and we're adjusting for the accrual. But again, had we not done this, we would have understated our expenses and we would have understated our liabilities. And let me stop for a moment before we do the next one. Okay, this is our last one, and I apologize, I forgot to mention the last entry we just did was an adjusting entry for an accrual. So that was for the interest, that was an adjusting entry for the accrual. Okay, this is for salaries. Our employee made $3,000. When we last paid him, he had worked for 10 days. So if you divide the $3,000 by 10 days, it means the employee earns $300 a day. On January 31st, we owe the employee for 7 days of work. So he's worked 7 days, but his paycheck isn't due yet, so we haven't paid it. So if you take the $300 per day we owe the employee and multiply it by the 7 days owed, it means we owe $2,100. So that's going to be a salary expense of $2,100. And since we're not paying him right now, it's going to be a salary payable of $2,100. And one other thing I want to mention is, of course, you'd also use all the previous T accounts that we did previously. The items that I've put up are just the ones that were adjusted. But in the information I send you, which will include the adjusted trial balance, you will see a listing of all the accounts and all their balances. But let's look right now and see what we have for some balances. We have supplies. The balance is now $700, right? That's our new adjusted balance. Prepaid insurance, balance is now $1,100, right? So our adjusted balance is $1,100. Unearned revenue, the adjusted balance there is now $4,000. And revenues, adjusted balance there is now $26,000. And our salaries expense, our adjusted balance there is $5,100. Okay, I hope this helps you.